Today, in debt ceiling land, what a difference 24 hours can make. Hello again, it's Martin North from Digital Finance Analytics, one of those posts covering finance and property news. Well, US stocks rose sharply on Wednesday, fueled by optimism over a potential deal on the $31.4 trillion federal debt ceiling. And as a rebound in regional bank shares eased concerns about an escalation in the sector's troubles, President Joe Biden and top US congressional Republican Kevin McCarthy on Wednesday reiterated their determination to strike a deal soon to raise the debt ceiling and to avoid an economically catastrophic default. If an agreement is not reached by June 1, the US Treasury has said it could begin to run out of funds to pay the government's bills, potentially igniting a recession. Previously, of course, yesterday, in fact, the markets were down because the risks seemed higher of no resolution, so things have certainly changed in 24 hours. And a jump in regional bank shares lifted sentiment, led by a 10.19% surge in Western Alliance Bancorp, a day after the bank said deposits grew by more than $2 billion in the quarter ending May the 12th. The KBW Regional Bank Index shot up 7.28% to notch its biggest one-day percentage gain since January the 6th, 21, to close at its highest level since May the 1st. And the S&P 500 Bank Index also surged 4.46% for its biggest daily percentage gain since November the 10th. It is optimism over the debt ceiling. It is continued optimism the banking crisis is in the rearview mirror. Every day we go without a new problem, the closer we get to maybe putting it behind us, said Rick Malek, partner at Cherry Lane Investments. Definitely the catalyst is when you get both Biden and McCarthy to say that we are close. The assumption is they probably will go with some kind of agreement. The Dow Jones Industrial Average rose 1.24% to 33,420. The S&P 500 gained 1.19% to 4,158. And the Nasdaq Composite added 1.28% to 12,500. The gains marked the biggest one-day percentage climb for each of the three major indices since May the 5th. Also providing support was a 4.41% advance in Tesla shares after its annual shareholder meeting on Tuesday. Top boss Elon Musk downplayed market speculation he may step down as CEO of Tesla, touching upon two new mass-market models the company is developing, and reaffirmed that deliveries of its long-delayed Cybertruck pickup would start this year. In addition, it seems that the electric vehicle maker is proposing setting up a factory in India for domestic sale and export. With the rally, the S&P is once again near the top of its recent trading range at about 4,160, which has acted as a resistance point. Analysts say a major catalyst, such as a debt ceiling agreement or clarity on the path of interest rate hikes from the Federal Reserve, would be needed to push stocks much higher. Recent data has indicated a slowing in the US economy following a string of Fed rate hikes to fight high inflation. That, along with recent negotiations over the US debt ceiling, has focused attention on when the central bank will pause hiking or cut interest rates, despite the fact that the Fed still is talking rates higher. Comments from the Fed officials suggested they're not ready to cut rates anytime soon. Richmond Fed President Thomas Barkin said he was comfortable with raising interest rates further if needed, but liked the optionality implied in the latest policy statement. And Cleveland Fed President Loretta Mester said she does not think the central bank can hold interest rates steady yet. And elsewhere, retailer Target Corp and TJX companies forecast current quarter profits below expectations despite beating estimates on the first quarter. Shares of Target rose 2.58%, while TJX companies closed 0.93% higher after a choppy session. The gains, along with Tesla's rally, helped lift the consumer discretionary sector by about 2%. So you can see here how the markets are very, very volatile still, and holding on to every grasp of news relating to the debt ceiling. As I've said all the way along, they will work it out. So I think it's highly unlikely that the US government will default on its debt. But it's going to be a tricky ride. And I still don't believe that markets have fully factored in two important issues. First, the Fed is likely to lift rates higher. They have been signalling that quite vigorously. And secondly, corporate earnings are still overprojected based on where things are actually happening. And those earnings degrades will come through and will force stocks lower. So we might well be out of some of the shade of the debt ceiling, but overall, the deep shades of the US recession is still significantly casting a long, long shadow across the market. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.